Now, for more on today's market action, we're joined by Rick Bensignor. He's the chief market strategist at Dahlman Rose, and also my guest, Bob Gelfond. He is the chairman and chief executive of MQS Asset Management. Bob's got more than 2 decades of experience on quantitative strategy in the market. You don't have any gray hair. How'd you manage to do this, Bob?
They do a good job in the
makeup room. Is that it? So what about the makeup of the market right now? Do you think that people are sort of just looking at what's happening in the retail sector and saying, all right, the consumer's back, go buy stocks?
I think some of the bigger issues are not off the table, but out of view from some of the market players. There was a lot of worries last month about Greece, about things going on really around the world, and some of that is off the table in the very short term. People are willing to put risk on, and the economy does look like it's still growing.
When you say put risk on, what does that mean? I mean, go out and buy stocks?
Buy stocks, buy commodities, sell the dollar. Those are essentially the risk positions. And then when something comes, whether it's out of the blue like Greece or maybe if the negotiations on the debt ceiling fall apart, then people get panicked and it's out of those markets and into safety dollar bonds.
Let me guess. That means volatility.
Exactly.
We're going to have to live with that.
I think so, until these larger problems are solved, which doesn't look to be imminent.
You were listening to Nancy Pelosi's interview, I bet. All right, Rick Bensignor, you got the market technicals all lined up for us.
Yep.
The S&P 500 just keeps climbing, as the Dow does, that wall of worry. It bounced off all those little market technical bases, moves higher. Are we in a breakout?
We're close to it. Tomorrow's number and the reaction to it could give us
the jobs report.
The jobs
number,
report
yeah? Okay.
and the unemployment situation could easily give us the clue towards what's going to happen next for, let's say, the next 50 to 100 S&P points. We're close to breaking out. I think we're a little short-term overboard considering how much we've moved up in the last 7 or 8 trading sessions. But I think on pullbacks, there is a psychological shift that's kind of underway here.
What's the psychological shift? People don't want to miss the rally. They're worried about showing their performance returns?
I think a lot of it's going to be benchmark chasing. There was a lot of selling that took place down near the lows, people kind of pressing bets that did not pay off. We were out with a research report about 3 weeks ago called the One Market Market, and we were talking about how much across asset classes many markets looked and had kind of the same picture. Everything was near its 200-day moving average, even in asset classes that should not be highly correlated. It was kind of scary because it's this whole risk on, risk off type situation that goes across all the asset classes.
Well, all right, so having said that and taking that as a jumping off point, Bob, if that's indeed true, that you've got these correlations in the market which traditionally shouldn't exist, as an investor, what do? Do you wait for some better market direction, or do you look at just individual stocks and performance? We're going to be getting those reports for second quarter earnings.
Our approach is that you don't want to have too much in any one place. You really need to be well diversified, and not well diversified in terms of having lots of longs, so not being long gold and long oil and long other stocks, but having longs and shorts on, or even have positions if you can't really short, being long bonds is something that's going to go up on days when the stock market in general is going to go down. It's the only way you can really do it, relative value.
What do you think about all of the money that has come into the world because of the central banks printing money? Is that just going to increase the volatility?
That has been the source of volatility. The Fed has provided a lot of dollars over the last few years. Other banks central banks around the world have been accommodative, and people don't want to hold. When you're in fear of inflation, you want to get those dollars to work. You don't just want to put them in the bank where you're going to get a negative return on your money. So you go into stocks, you go into these other risk assets. But on the other hand, when times start looking worrisome, then you've got to go into something safer, and that's what can lead to deflation and a bigger economic calamity.
All right, keep us posted on all of it. I want to thank you, gentlemen, very much. Bob Gelfond, MQS Asset Management, Rick Bensignor, Dahlman Rose.